Welcome to TheoTrade. This is Don Kaufman. May 3rd, 2023. Just about 18 minutes left inside of the trading day here on this FOMC afternoon. Got to tell you, this is all about rate hikes and vol spikes. SPOOs at this point are down 26 handles. Just hold it right there. Right here, right now, we are at an absolutely pivotal level inside of the S&P 500. We are actually closing in on the so important 4106 handle. And you can see that the marketplace is literally hesitating before dropping ultimately through it. This is actually what we term a gravity point, and you're very likely to see a big volume spike inside of the S&Ps. People, the 4106, and I'm going to write it up there as we are actually looking at us breach through it. But this 4106 holds absolutely strategic weight inside of this marketplace, and ultimately cracking below it, I think at that point the marketplace turns into just a volatility cluster at that point, which is just some heavy sell side activity. But okay, with all due respect, we are hanging on right now by a thread. 4106, a critical level, something I talked about extensively in this past weekend's update. And again, the market's really hanging on to this gravity point like it is grim death at this point. All right, let's kind of recap some of the action in the markets. I mean, quite frankly, nothing has transpired ultimately until the Fed spoke. And you talk about some volatility, but the beginning of the Fed was ultimately the rate hike, which occurred right here, and that happens to be at 2 p.m. Okay, that was 2 p.m. of course Eastern time, and then of course we started hearing from Jerome Powell right here. And I'm just making the point that we were massively unchanged at the end, at the very end of Jerome Powell's discussion. We were somewhere right here, which again is a mild, maybe a two-handle change. That's a 2 S&P point change from the beginning of the FOMC meeting. At this point in time, again, markets have progressed a little bit lower. But let me show you again, kind of in context of why current levels are so very, very critical. Okay, yes, the 4106 holds tremendous weight. And I'm actually going to zoom out for just a second and show you exactly why. First and foremost, if you take a quick glance, this is a 30-day 1 hour, and I'm going to go ahead and just close up that left side bar for just a moment. Markets are bouncing a little bit here, so it ain't over, people. I mean, with 15 minutes left to play, it's definitely not over. But I wanted to show you why this is such a critical level, and ultimately this is a 30-day 1 hour chart. If you look back now over a period of an entire month, almost all the trade that has transpired, okay, has been once again in a 100-point range. I mean, we're literally trading 4,100 to 4,200. Okay, to get even more specific, in the S&P futures, this, what I call like the thin red line is actually on that 4106, and it has become, if you will, that kind of break point in the marketplace. Clearly, we did drop below the 4106 last week, and we did see wild spike in volume, some heavy volatility hitting the marketplace. But we came down literally and hit 4106 on the button yesterday. And again, volume spiked, volatility started to surge, and we immediately rebounded off of it. Again, I think this has really become kind of this red line for the marketplace, and that breaking below it, again, the only way to really delineate, a break below the 4106 is to present this. It becomes a little bit of a free-for-all to the downside. Now, just a mild breach below 4106 isn't going to mean anything, but there's a bit of confluence of the 4106 in the S&Ps, to, I'll bring up the SPX. We're actually at, right this moment, the lower edge of the expected move inside of the SPX. And I'm actually going to bring this up on a intraday chart, from this level that I'm highlighting right here, and that's about 4170. And again, it's 4170 into the SPX, to right down here, this lower edge of the expected move, you're basically looking at just over a 70-point move. So 70-point move to the downside. We're actually starting to breach the lower edge of the SPX expected move, which, okay, ultimately could create some hedging activity because we're, well, outside the edge of the expected move. That's what we call dynamic hedging. And effectively, as we start to break through what just feels like, you know, a line on the screen, we start to break through that line on the screen, okay? Servers literally are going to turn on and start to actually hedge because ultimately that's where many derivatives firms that are negative gamma are going to start to eat a whole lot of risk. So we have, again, just kind of interesting kind of confluence of events going on where the SPX, okay, is kind of commingling right here. Check it out, okay? Here it comes. It's right on the edge. The 4106 correlates, if you will, with the SPX expected move, and that is why it's become such an just incredibly critical level. It's also one of the reasons, and again, as I zoom into this, and yes, we're back on the S&Ps, as I zoom into this, a lot of people are asking me the question. Look, I like to sell premium, and I especially like to step up to the plate, and I love to sell premium, okay, at the upper end or lower edge of an expected move. But in this particular situation, today, I have not sold premium. Yesterday, I did not sell premium at the lower edge of the expected move. And I think that's probably gotten some people, you know, turning heads, a lot of emails coming in. And I'm going to tell you again exactly why. Let's see what happens to 4106. We might actually see some fireworks. And that's why I entitled, you know, today's video, you know, ultimately about Fed hikes and vol spikes, because you want to see some volatility. You're going to see just that if we actually cross underneath this. And again, as I said, we are aligning to still break it. It's great. Started this video like 7 minutes ago, and I'm like, it's going to break. It has not broken just yet. You're going to know when it breaks because the volume will take off. We might do 7,000, 8,000 contracts inside of 1 minute as we start to breach through the 4106, which further, again, kind of delineates how critically important this particular level is. It's, again, you know, servers will literally turn on and start to actually hedge in the dynamic of the marketplace as we breach through that particular level. All right, at this point in time, and again, I say this with all due respect, okay, you push aside a little bit of what you think about individual stocks. Everybody's going to be infatuated, but what about Apple? What about Apple? Okay, because at this particular point in time, Apple coming out after the market tomorrow, push it aside a little bit. What I'm much more concerned about is the advanced decline line. What I'm much more concerned about is this particular level. What I'm much more concerned about is, you know, oil. Okay, I mean, look at oil. It's absolutely in the tank, pricing in, you know, a dramatic pullback, you know, economically at this point. All that's standing between us and the abyss right now. I mean, look, it's not financials. I mean, look, financials are already down almost 7% year-to-date basis. Take a look over here at energy. It's almost down 7% year-to-date basis. What do you got? All that stands between us, okay, and the abyss is a handful of tech stocks. I mean, that is it. You want to look at like consumer staples? That's not going to do it, though. Consumer staples is not going to hold the marketplace to the upside. I mean, you can imagine if you want to bring Apple into the conversation, you can imagine if Apple actually missed, okay, the damage that would inflict upon the S&Ps would be just incredible at this particular point in time. So again, we sit, we wait, all right? If we're going to sell some premium, I'm just going to be forthright and tell you, look, I, for one, I'm going to be a little cautious into this one and say, hey, let's see what happens after we cross through this 4106. And I do not mean just crossing through it by 3 or 4 points. Let's see us get a little bit crazy to the downside. There could be some really huge opportunities here because, again, not only are we at this, you know, this 4106, we're also, okay, the possibility of not just breaching the expected move, but breaches to expected move. We may end up at like double the expected move. You still got Thursday and Friday of this week. Now, remember, again, the entire week held just over a $70 expected move. Yeah, we're over and done with that. Okay, so what do we got right now? And now the entree comes, and we could actually see a move that could even be equivalent to, if you will, double the expected move. If you will, let's go over to the SPX. One final look here into the SPX. Again, SPOs are down just about 30 handles. The remainder of this week, what's the market really looking for? I'm going to love this because it's still, okay, even though everything that's already transpired, and we're already down over 70 points on the week, still anticipating, okay? What? Almost a $56 move. Yeah, you got Apple in here. Yes, you have the employment situation. Got a whole lot of risk ahead of us, okay? Do not force anything in this marketplace. I say this very often while I'm live, okay? I might not be live, but hopefully the voice in the head is. Let this marketplace evolve a little bit, okay? Sure, we're headed to the downside right now. They may mean nothing. Well, again, we can't reach the 4106 over here. Let it happen. We're going to rally back up. We're going to get crazy. It's fine, okay? But the risk right now is very apparent. It's to the downside. It's significant, okay? When we start to actually breach through major levels, you will see volatility spikes. You will see volume spikes inside of the S&Ps. And from that point, it would be on. With that, I want to thank everybody for tuning in to TheoTrade. Have a wonderful evening. Bye-bye.